Let's go back in time to the early 1970s when the United States government was facing a lot of financial problems. The United States government had a lot of bills to pay, but they didn't have the money to pay those bills, and so the United States government was on the verge of bankruptcy. Now that might sound a little weird in today's economy because you might say, can't the United States government just print the money and then pay off their bills? Well, yes, today they can, but they couldn't then. Because back in 1970, our money was backed by physical gold. Our dollars were backed by a precious metal, physical gold. So if the Federal Reserve Bank wanted to go out and print more dollars, they needed more collateral, more physical gold to justify that money printing. We didn't have that. So to fix this problem, then President Richard Nixon in 1971 took the United States dollar off of the gold standard.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
This meant that our paper money is no longer backed by physical gold, and so now the United States government can work with the Federal Reserve Bank to print a blank check. And that's exactly what happened. The Federal Reserve Bank wrote the government a blank check. The government then paid off all their bills, and we avoided bankruptcy. And so this solved the economic problem in 1971. But then it created a new problem. The second problem that we had from all this government spending was inflation. It led to the super high inflation rates that we saw in the late 1970s. Now, to fight this inflation crisis, which was caused by the Federal Reserve Bank printing a whole lot of money for the government to spend, the Federal Reserve Bank stepped in again. Now it was a guy by the name of Paul Volcker, who was a chairperson of the Federal Reserve Bank, who raised interest rates significantly. He took the federal funds rate up to around 20% as a way to fight inflation. Now, to put those 20% interest rates into context, the interest rates that the Federal Reserve Bank has set for today is around 4.25%. So 4.25% today, 20% then. This move to raise interest rates by the Federal Reserve Bank in the late 1970s and the early 1980s brought the inflation rate down.
To break the inflation cycle, we must have credible and disciplined monetary policy. And it worked. Inflation fell quite sharply. You can see from 1980 to 1983, inflation fell all the way down to about 3%.
So it helped fight the inflation problem, but it then had another consequence. And the other consequence was economic pain. It ultimately led to the painful early 1980s recession. So why am I telling you the story? Because while history doesn't exactly repeat itself, it does rhyme. In the early 1970s, it went from a lot of government spending, which created an inflation problem, which led to the Fed raising interest rates, which then led to some economic pain to solve that problem. Well, what are we seeing today? We had a lot of government spending, which then created a lot of inflation, and then the Federal Reserve Bank raised interest rates, not as aggressively as we saw in the 1970s, but aggressive based off of today's standards, and that is now leading to confusion in the economy. But we have some changes now. For example, the Trump administration is talking about cutting taxes while also reducing government spending. So now that you understand that, let's move on to number 2, weathering the storm that we're seeing right now. Here's a fact about our economy that people try to forget. Recessions happen. They are a part of our economic system. In fact, over the last 100 years, do you know how many recessions we've seen? It's not 5, it's not 10, it's not 15. It's 16 recessions over the last 100 years. And over the same 100 years, we have seen 25 bear markets. That's 25 downward stock market movements where the stock market has fallen more than 20%. Recessions are a part of our economy. They are the way our economy works. And many people forget that that happens. And every time that recession happens, 2 things happen. Somebody gets wiped out and somebody gets rich. And in order for you to actually build wealth during those periods of economic pain, you have to understand the system. And that starts by understanding the different ways that you can actually win. Now I'm going to talk more about that in number 3, but speaking more of weathering the storm. We don't know what's going to happen tomorrow. We don't know what's going to happen next week. We don't know what's going to happen next month or what's going to happen over the next 12 months or the next 3 or 4 years. We could see a recession. We could see an economic boom. I'm not here to predict because nobody knows. But what I do know is we will eventually see a recession, and you want to be able to weather that storm whenever that happens. And this is where I want to remind you that every time there's a loser, there's also a winner. For example, if we take a look at what's been happening in the stock market just over the last few weeks, we saw the news of the stock market falling. We had all the news of cryptocurrency prices falling. But when that was happening, when stocks and crypto was falling, do you know who was winning? Well, gold prices were going up the same day that stocks and crypto were crashing. Not to mention, we also got news that home prices were also going up during the time where stocks were crashing, during the time where Bitcoin and crypto was falling. This is where, if you are an investor, real diversification can be very useful. But this is the thing that so many people get wrong. Now, I get it. I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But when I talk about real diversification, I am not talking about diversifying your money in your stock portfolio. This is what most people think about. They say, I have a growth fund, I have a blue chip fund, I have the S&P 500 fund, I have an innovation fund, I have an international fund. So doesn't that mean I'm diversified? Well, if the stock market crashes, chances are all your funds are going to be hit. So that's not real diversification. Real diversification is having investments in multiple different asset classes. I'll show you what I do. I don't recommend what I do to anybody else, but I'm just going to show you to kind of help you think like an investor. I invest my money in 5 places. Number 1, my largest investment is into my own business, Briefs Media. Number 2, I invest money into physical real estate. Number 3, I invest money into stocks. When I say stocks, I mean passively into stocks and actively into stocks. It's almost 50-50. Passively into stocks means into my portfolio of funds that I want to invest in. Actively means when I'm looking for individual companies to invest in. Number 4 are my speculative investments. These are the startups that I invest in and the cryptocurrency that I invest in. I say speculative because, well, they can go up very quickly, but they can also crash just as fast. It's a smaller piece of my portfolio, and so I understand it's more on the speculative side as opposed to more of the proven side. And then number 5, I own a little bit of physical gold. It makes up about 2% of my total portfolio. I don't look at this as a traditional investment per se. This is more like an insurance, doomsday protection. My theory, and this is just my theory is that if I took $10,000 worth of cash today and $10,000 worth of physical gold today, buried them both in my backyard, and then dug them up in 10 years, I believe that the gold will have more buying power than the cash just because of inflation. Do I know for sure? No, but that's why I have a little bit of gold as my diversification and insurance. For me, I call this real diversification for me because in 2022, when the stock market fell by 20%, this got hit very hard. But real estate prices, rental rates were booming, so this was going up. In 2020, when the stock market was crashing at the fastest rate ever, crypto prices were crashing at the fastest rate ever, real estate prices were still going up. When the 2008 housing market crash happened, real estate prices didn't bottom out until 2012. So real estate prices kept falling until 2012. That was the worst period of real estate. But in 2012, the stock market was booming during that same year. So if you want to be able to weather storms, because storms are going to happen in the future. Yeah, we're seeing a little bit of volatility, but we haven't faced a real storm in a while. When that storm happens, if you want to be able to win through the chaos, through the craziness, having some real diversification can help. You don't have to copy me, but you can find something that works for you. I should also mention that in 2020, when all the craziness was happening, gold prices were also going up as well. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.